Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another episode of the What Matters podcast. I'm Mike Mershazadeh, and this is my co-host,
Ashley Ward.
And today we are interviewing Kalei. As of recently, I have watched several of your, I believe it was CNBC videos, video clips, and I took your advice. I took some chips off the table, and I want to sincerely appreciate the motivation of listening to your video and what that gave me to do that, because oftentimes, you like watching the market go up, right? And there's greed involved, right? Because you're like, well, what if it continues to go up? I believe 10, 15 minutes ago, prior to the call here, you were talking about how you think that the market's a bit overextended. Before we get into everything here, would you mind giving us your opinion there?
Sure. Like you mentioned, greed is I think Gordon Gekko said it, greed is good, but not all the time, right? And so I think when we look at the current environment that we're investing in, it is not, we like to use analogy of spaghetti and walls. So it's not an environment where if you throw a plate of spaghetti that all things stick. It's also not an environment that all boats will rise. There's a number of factors and variables that are affecting that, and why we've come to that conclusion. Part of it is valuations. Part of it is an inversion of the yield curve, where the shorter end of the yield curve is higher in yield than the longer end. That's just non-traditional. That's not what our financial kind of institutions are based on, and our financial, just all of the inner workings of all of our financial institutions. And so I think the dynamics of that, with increases in inflation, although they're, tend to be on the downside, still just don't lend us to a period of time that is that calls for risk being on 100%. So I think taking some chips off the table, being prudent, looking at valuations, can earnings, I won't name the name of the company, but can earnings grow at 300 times current rates? Are we in an environment that warrants that? And should the price be at that level? So I think it's prudent and wise to take some chips off the table when you can. Unfortunately, many investors aren't in a position to be able to do that. They don't control their investments. They're stuck in mutual funds or something, and they're at the whim of other managers. So I think when you have control and you're able to do it, keeping a keen eye on markets is important, and taking chips off the table and knowing when to do so is important. So good job. Market's down today.
Would you say that you're more of a contrarian in the market?
No, I wish that we were, because we like to take the contrarian side, because that's usually when there's opportunities. It's not unlike business, right? When risk goes up and the rest of the street is looking one way, there's an opportunity somewhere. We're hearing more and more analysts, more and more managers that are saying, hey, we're concerned about valuations. We're concerned about policies going forward. And we just don't see things in place that warrant the valuations that we're currently in the market.
So you're thinking that maybe NVIDIA having a PE of like 300 right now might be a little bit inflated?
I think NVIDIA is a great long-term holding. However, I do see, potential downside risk. 300 times is kind of mind-blowing, especially when you're beginning to see cracks in our consumer-led economy, right? You're beginning to see 30-day delinquencies on the rise. You're beginning to see, even some of our economic data beginning to, although it's not in recessionary territory, it's definitely slowing. And so if the economy is slowing and consumers are beginning to get more and more strapped and not have the cheap credit that they had before available, and they're having to service higher levels of debt, then I question whether the earnings can continue on the pace that's leading at a 300-time multiple. It's just
Gotcha.
It's not a matter of the company fundamentals. It's a matter of valuations for NVIDIA.
Yeah, I thank you. I really appreciate you answering that. And one more question I had before Ashley gets started into our scripted questions there.
Sure.
Now, do you think it's because right now there's there's a lot of debt that was taken out, and a lot of that debt recasts in the next year or two for major organizations?
So the amount of debt that we have in the system, whether it's in our financial system or just in our global economies, has only gone higher than it was in the great financial crisis, right? So you would think we would learn from what transpired in the GFC. However, we've had pandemics, we've had all sorts of things that have happened that were not kind of in the playbook, if you will. And so our response to those very dramatic issues were to issue and assume more debt. Now, eventually that debt comes to roost, and it either has to be what a lot of investors don't realize is, quite a few years ago, the United States Treasury stopped issuing long-term debt. They stopped issuing 30-year bonds. And so they re-upped that, a few years ago. However, there's a period of time when there were no long-term bonds available. And so a lot of the debt that our country has is beginning to mature. And so now our country is faced with reservicing and refinancing at higher rates. The Federal Reserve kept rates artificially low for, call it 15 years. I mean, we've had the spring break of all spring breaks, right? And free for all. So the cost of capital was extremely low. And in our opinion, artificially low. And so, uncle's come in and he's taken away the keys to the flotilla, and he's saying, no longer am I going to fund this, right? And so we're going to let rates normalize. And so the cost of capital, the cost of debt has gone up. And so I think for many, the party's done.
Yeah. Thank you. I appreciate that.
You're welcome.
Yeah. So Kalei, let's go into speaking a little bit about you. Can you tell us a little bit about your background and your experience in the financial industry, and really what led you to becoming the president and CEO of Cadinha Co?
Some people have really clear lines, A to B to C. I am not one of those. I am the second generation of leaders at Cadinha Company. My father actually founded Cadinha Company back in 1979, and I will say that I was here on the day that he founded it, and I was employed. I've worked my entire life at Cadinha Company in various capacities, but I really struggled with family business and family dynamics. And so I tried to aspire to as many other professions as I could. I tried teaching, I tried all sorts of stuff. But investing's in my DNA. From when I was really, really young, we weren't the house that had all the cool Christmas toys. I learned pretty quickly that one year I really, really wanted roller skates. And so, Christmas Day, I got up and I opened my presents, and I didn't have roller skates, but I had this envelope on the tree.
I knew it.
Oh. And I opened that envelope and I thought, okay, cool, money for my roller skates. And it was like, you're the proud owner of 10 shares of XYZ Corporation. I won't name the company. And I didn't even understand what being a stockholder was. I didn't understand what investing was. And at the time, I got to admit, I'm going to be really candid with you, it stunk. I just wanted roller skates.
Right?
But now hindsight is always 2020. And I see what a tremendous gift that my father began instilling in us and really planting the seeds of investing and understanding it. So Thanksgiving, I like to refer to it as a dissertation. It certainly felt that way, but it was, we had to come up with ideas of what companies we wanted to be owners in. And that's what we got for Christmas. We still got some cool little toys. My mom was like, okay, here, you can have some shoelaces or whatever. But they believed in investing, and they believed that we had a place, and they understood the benefit of time, right? If you're a 6-year-old child and you're investing in 10 shares of XYZ Corporation, I'm now in my mid 50s. imagine the growth, of that investment over time. And so, so I've been an investor all my life. And I came on board at Cadinha Company, after leading, I worked in the South Pacific, and I worked for the American Samoan Government, leading some of their economic and Department of Labor initiatives there,
Wow.
just really trying to make a difference in the Pacific, where there's not a ton of opportunity there. It's kind of like, you have the canneries in Samoa, and then you have government, and if you don't have either, if you're not in one of those two industries, you're unemployed. So just trying to make a difference. My husband is from there. And so I didn't realize then what I realize now is that I really needed to have a mature mindset of being able to work and function in a family business. So, it's beyond the investments in my DNA. But I had, I was working for my father, and living with my boss when, prior to being married and having a family. And that dynamic was one that I needed to be better at and needed to be at a certain maturity level. So for me, it just took time for me to get to, kind of where I am now. So I started back at Cadinha in trading, and then within a couple of months sat for my Series 65, and then began advising clients. And that was back in 2000. So, started on that path. And in 2007, was selected by a group internally to lead the firm, to become the president.
Wow.
And then, I had, as the next generation, I kind of had my idea of how to keep the wonderful, beautiful things that's in our DNA of the firm, but also begin to shift, because things have changed in our industry since 1979, right? Competitors, referral sources then are now competitors. And so there needed to be a mindset and a shift. And then Cadinha, primarily just with technology, we were kind of relegated to providing investment advice only for the state of Hawaii. But with technology at our fingertips, basically in 2000 when I came back, I was like, hey, we don't have to only be a Hawaii RIA. We can provide, if we have a good thing and we have value added services to offer others, let's take it nationally. And so we began on a national trend, doubled AUM within 5 years, and then I was promoted to CEO of Cadinha Co.
I read that. I read that. Let me ask you this. You said 2007 you became head of the company. Is that correct?
I became president
of the company.
Mm-hmm.
So obviously the year after 2007 and the following year, what a year to be put in power there. So how did that play out for you? What was it like? Wow. Did you get, shall I use the word, the red finger pointed at you saying, oh, this is your fault because we just made you the president? Or was it like, hey, listen, this is going on with everybody, and you had to, you made the best of it and got you and your company out of that jam?
Really interesting question. I am a very non-traditional, non-conventional leader. I believe that challenges and difficult times are really opportunities in disguise.
Love that.
So we were calling in 2006. We were calling for some really difficult times ahead of us. We were looking, kind of like the NVIDIA story that we just talked about. We were looking at prices of homes. We were looking at just supply and demand and all the different dynamics that affected the financial crisis. And we knew the markets had gotten extended. We never knew to the degree at which things would fall, but we definitely were bearish going into 2007. But so my father, who founded the firm, the philosophy of Cadinha Company is really capital preservation. So we're really good in down markets. We significantly outperform. We always take the chips off the table, kind of unapologetically. We'll go there. But I think the difference between my father and I is that I do look at those difficult times as opportunities. And so that's where, the team called me and said, hey, I was president, my father was CEO, and it was part of our succession plan. Not initially when I started. I have an older brother who also works at the firm. So that's a whole nother story. That's for a whole nother podcast. But it just, the times were kind of like, we had to make a business decision. You know, are we going to shrink like everyone else, or what are we going to do? And so I risked my reputation. I said, we're going to grow, and this is how we're going to grow. So we allocated resources to really getting our messaging out. It helped that our performance was superior to pretty much everyone else's. A little bragging point, in 45 years that we've been open, we've never had a double-digit down year, right? So
wow, really?
So that's when you're talking about financial crisis. On the domestic side, you had the domestic markets down, call it half, 50%. But on international, you had if you're in international, people were down 75%, 80% of their assets, right? So when you have like a negative 7.9 year in that type of environment, you're the top dog. You're one of the highest producers. So I just said, this is the opportunity for us to, this is not a time for us to put away our nuts and call them. This is the time to spend and really just launch our marketing efforts and try to seize market share. So it's very opportunistic at that time. I remember it really clearly. It was gut wrenching, just the pain on the street and what people were encountering, and really the lack of understanding of what happened, how their wealth just evaporated, was, to me, one of the biggest life lessons, was just knowing when to take your chips off the table, and then preaching. I spent a lot of time doing pro bono work, just trying to educate the average investor on what to look for. How do you determine fees? How do you determine what your asset allocation is? So that's what happened in 2007. And I will say, we were just very fortunate and blessed. We got lucky with the call.
That's
we could have been really wrong. We were 0% in financials, where the S&P was, over 30% in financials. We went to 0. So we made some really big bets on sectors, and it just, it landed on our side.
Thank you.
Fascinating. Yeah. So you kind of went into my next question right there. Building any successful venture really comes with its share of lessons. Any valuable lessons that you've learned, in addition to what you already mentioned, as an entrepreneur in the wealth management field, and being, part of this entrepreneurial family that has, built this RIA and it's continued to succeed?
Tons of lessons. I kind of, I'll just rattle off a few. One is just being flexible. You can have, I'm a planner. I provide financial planning services. By nature, I'm a planner. I'm a mother of 4. I've got to have a planner. They'll tie me in a knot. So, planning is my thing. However, you just can't plan everything. We're not in control of 90% of the things that happen in our lives. And I think the faster one becomes accustomed to that and is able to allow for flexibility and plans for the unplanned, the better. So that's a huge lesson that I learned just along the way. Keeping current. It's really easy, especially when you're busy and you have life. My older adult children like to refer to it as adulting. When you're adulting, you have all this stuff you got to do, and it's really easy to get stuck in that race and not poke your head out of the forest and see what's really happening. I think it's important to keep current on all trends, whether they're regulatory, macroeconomic, tax, community, whatever it may be. Keep current, be present, understand. Don't just put your blinders on and assume that things are going to be the way they have always been. Disruption is one of the key names that a lot of us talk about, right? And what's going to be the next disruptor? Disruption is happening daily, even every minute. There's technology is providing innovation so quickly that if you don't keep current, you'll be a has-been really fast. So I think it's really important to keep current on all trends. And I think the last one is to be discerning. Take time to every year, and this is how I do it, that I provide space for myself to really just kind of ascertain where we are, where we've been. I like to do it in the month of October, so we're getting there. And the reason I choose October is because I'm going into a period of Thanksgiving where I'm able to be thankful and grateful for everything that has been provided. But because I'm a planner, I also have my yearly goals, and I still have a full quarter to kind of like right the ship if I need to. So I like to take October as a time of reflection, and then through that reflection, I've learned that it allows me and affords me discernment. I'm able to really kind of see what's around, what's available, and then apply it to the way that we're operating. I think those are really some key factors that have helped me along the way.
Thank you.
Yeah, those insights are golden. And in the early stages of your career, were there any risks that you took that you feel ultimately contributed to your growth and success?
Absolutely. So backing up to prior to me returning to Cadena. So growing up in Cadena, obviously I was like, the gopher, and I picked up, I was the champion of will work for food, right? And so I started at that level, and then I adulted. I got married, had 2 children. I ascended pretty quickly to be the director of the equivalent of the Department of Labor for the American Samoan Government. So I was involved in putting together economic and employment types of policies and programs. And so I was super proud of myself. I was like, "Woo, I made it." And I had 2 children at the time, and my oldest was 2, and I was just looking at schools, preschools, medical facilities, all of that. And it just wasn't at the caliber that I wanted and I desired for my children. And so I said to my husband, I said, "Hey, we got to go back to Hawaii. We got to go back." And I had recently launched the Economic Coalition for the for the Pacific region. And I felt, so I've always been kind of a team person. I competed in Division I athletics. Team is kind of just another thing in my DNA.
Can we back up a second there?
Sure.
You said, I apologize. Something I was interested in. You moved back to Hawaii from where?
From Samoa, from American Samoa.
Oh, wow.
So that's where I was working for the federal government in their workforce initiatives. And the governor basically, I came on as a program director, and then within 2 months, I was promoted to the director of the whole division. So it's kind of they call the employment division, employment and training division, but it's basically kind of the Department of Labor. And so in that, I familiarized myself with federal funding, with grants, with all those types of programs. And what a lot of people don't understand is, there's these U.S. territories that are in the middle of the South Pacific that are delegated a certain portion of federal funding, right? So let's just, for round numbers, let's say 10% of a budget goes to that area. And then what they do is they split that 10% amongst all the contingencies within the South Pacific based on size. And so I looked at this, and they have a regional oversight, and I looked at the dynamics of funding, and I said, guys, there's 10% that's being kept for administrative purpose, for administering our grants and our funding. I said, let's just collaborate and come together so that we administer ourselves, right? And maybe we can get a portion of that administrative fund. So I launched the Coalition for Economic Advancement in the South Pacific, and that's what I came. So I came from that. I was offered a position with the administrative oversight when I said I'm moving back to Hawaii, and I was hunting for jobs and figuring out what I was going to do. And so the very organization that is responsible for that administrative piece in the South Pacific offered me a director's position, far more than I was making in Samoa. I thought, okay, I got this. And then that's when my father said to me, he's like, well, I have this trading position available at Cadena. And I'm like, you want me to be a trader? I'm a director. Like, no. Mm-hmm. And so we talked, and I said, okay, well, what do you pay? And he gave me kind of the whole spiel, and it was 30% of what I would have been making as a director. So actually, it's a long-winded conversation. Answer to your short question. I gave up compensation. I could have been on kind of that, I would call it civil service path, which I enjoyed and I was passionate about. but not as passionate as I am about investing. I've invested my whole life, and I love what I do. And my dad, was able to still, he was linked to my account that I had as a little child. So even though I was in Samoa and I was, I would check the markets, and I mean, we were on dial-up modem, so I was trying to get my trades in and time difference.
Yep.
He's like, hey, you have a good look, why this? And we would talk every now and again about it. And so he offered me this position, and I said, listen, I would love to come and work for Cadinha. I would love to be a trader at Cadinha. I'm like, here's the things that I'm struggling with. And it really boiled down to family business. It had nothing to do with the business that we offer and the services we offer. It was the dynamics of family business that we needed to work out. And so we, on a cocktail napkin, we penned out our rules of engagement, and they're really simple. Do not discuss family when you're at work, be professional, and do not discuss work when you're at family. Like, so if we're at Thanksgiving, I don't want to talk about the markets. I want to be present in, we wear many hats. And I want to be present when I'm a mom. I want to be able to give my children the 100% when I'm with them. And I want to give my work the 100% when I'm at work. And so those were the things that I really wrestled with. And so we have an agreement. Every now and again, he breaches all the time, but I pull out the cocktail napkin. I'm like, bullet point number 1. So, but that's what I learned, and that's what I gave up. So I gave up compensation for really passion, and understanding who I personally am and kind of my purpose and in my life. I'd like to think that I do a decent job with my clients. I love them dearly. They become family to me. But I'm also really kind of a economic nerd. I mean, I love to read data and study it and identify trends and see next hot topic and next idea. Not very many people can say they love what they do. I'm one of the blessed ones that says I can.
Well, thank you. And we'll delve into, some hot topics regarding the market in a little bit here. A question I had for you, because I, presently my twin brother for the last 22 years, half my life, we've been business partners. And every Saturday, I work till about 2:00 on Saturday. And then for the rest of the weekend, I'm off. Right. And he'll manage to call me up and, and he'll start like chirping about the business. And I go, hey, listen, as a matter of fact, he goes, I got some critiques for you for the podcast. And I said, it's also Sunday. You could remind me of you could critique me. I'm open to it tomorrow, not today. So I agree, and on top of it,
you got to establish boundaries. I mean, part of being an entrepreneur, but even more importantly, a leader as an entrepreneur, I think good leaders are humble, and I think good leaders are selfless. Right. So you're constantly giving, you're constantly considering other people. You're constantly trying to make people better, a better version of themselves. I think that's what a good leader does. And so because of that, it's really easy to lose track of yourself. You just get caught up in everybody else's stuff. And then you layer on top of that, the industry in which we operate, and you're trying to help families and people and business owners live their best life. Right. So I will say one of the things that I've learned, and it's really only been in the last few years. So context is important. So I have a 25-year-old, a 24-year-old. Those were the two that were born when we were in Samoa. And then I have a 19-year-old, and then I have an 11-year-old. So and same husband.
Did the 11-year-old happen? Did that come from a new husband? Just kidding.
Yeah, everyone's like, well, that's a big gap. Things happen. And so I will say, though, that my older two refer to their upbringing as being part of a totally different household than my younger two, especially my youngest, because I was, in my early 30s, and I was just trying to establish myself. I was working unbelievable hours. I still work unbelievable hours, but I didn't take time off. So I was with Cadinha in 2000 and then ascended in 2007 to be the president. And on the day that I accepted that, my dad said to me, he said, okay, your first duty is to take a week vacation. And I was like mind blown. I was like, what? I'm in this new position. I got to, my head was just spinning. And And he said, I pulled the records and you haven't had a vacation in 7 years. And so I would take vacation, but I use my vacation for my children, right? Sick leave. If I get a call from the school, they're sick, I take vacation day. But I never had a vacation for me. And so that's when my dad said, you will take vacation and you will go on vacation. And I will say I can pin the day that was in February of 2007. I was on Main Street with my family, Main Street of Disneyland with my children. My husband and my mom joined us on February 27th. Look it up. That's the day the market crashed.
Yep.
So I had my iPhone, and then I had what I refer to as my bat phone that I do all my work on. And I was just like, we're marching her in to get her little crown and her sticker and everything because it was my daughter's birthday. And I was frantic on my phone, and I'm like, you got to do this. Calling my trading desk and everything. And my mom just walked up to me and she grabbed the phone out of my hand and she put it in her purse and she walked away. I was just And then my husband came out with my daughter and he said, go to the airport, get on the plane and go back. Your mom and I have the kids. Go do what you have to do. And I just sat there and I had to make a decision, which was the priority in my life. And I realized that little old me can't stop the market from crashing, right? There's just nothing I can do. But my family needed me. And so I made the decision to stay on Main Street Disneyland. And
good for you.
But those are some of the compromises. Those are some of the choices, tough choices that we make as leaders. But I reflect on that now. And it's something that, I will say wasn't my proudest moment, but is something that I share with clients, with my team. I'm like, hey, you're dealing with, an aging parent that has some issues. Go handle it, because I realize we're only as good as what someone brings once they step into the room. And if their mind is worried about a family member or whatever it may be, they're only operating at 50% capacity. And so I say, you go, take the time that you need, and you come back when you're ready to serve 100%. So that was one of the things that I learned.
Now, let me ask you this: Are either your sons or you have a 24 and a 25-year-old, both boys, correct?
3 girls, and then the son is the youngest.
Oh, my apologies. No
so,
are any of your children in the business with you?
So number 2 joined us in January of this year. Unbeknownst to both she and I, we never. I knew she was going into finance. So. Again, context. Number 1 and number 2 were both Division I athletes as well. So number 2, COVID, right? So number 2 was in the middle of volleyball, her volleyball career at Creighton. And so you may not know, but many athletes have an extra year because of the pandemic. And so she graduated in May, and she had an opportunity to play one more year. But she knew she wanted to get her MBA. And in finance. So she looked at all her options, and she ended up getting a grad assistant position at Creighton, and which allowed her to not play, and she could finance all of her master's degree. And so she did that. And so she did the internships in between the 2 years of her MBA, and latched onto a wirehouse, a large corporation that I helped her kind of navigate. I said, hey, I think you should during the summer, I said, I think you should take this opportunity. And so she worked in the summer for her internship, and then she continued on during the fall while she was attaining her MBA. I get a call. So then she goes through interviews, and she gets a job and gets placed with this company. And she's supposed to start in July, right, of last year when she graduates. And so, it would have been July of this year. And I get a call in like the end of October, early November, and she's like, hey, I just met with my dean, and that while she was doing her internship, she also kept taking classes. She found out that she was going to graduate early in December. She's like, I'm graduating early in December. What should I do? So I said, well, call gigantic corporation and say, hey, I'm graduating early. I can start before July. The corporation told her, we have an incoming class. They refer to them as classes when they come in. And so, no, you're scheduled in July. And so my father had been asking me, he's like, you got to pitch her. She fills all the boxes. And as her mom, excuse me, I wanted her to explore other things. I thought if she eventually comes to Cadina and Company, I want her to have the experience outside of Cadina.
Right.
And I thought, I really truly thought that she was more interested in M&A, which we don't do. So mergers and acquisitions. And so, I thought that would be a better fit for her. And so she talked to my dad, and the next thing you know, I get a call from her, and she's like, hey, are you in the middle of something? I said, no, I got a few minutes. What's up? She's like, check your email. So she did this presentation to me about all the merits of her joining the Cadina team, what her value added is, what she likes. And so we had that conversation, and we had to have kind of a cocktail napkin conversation between she and I. And it's interesting because, you had my father's generation, so Gen 1 to Gen 2, and then another conversation to Gen 3. And I was able to look at it from a different lens. Now I had the perspective that my dad had when he was trying to get me to come over to Cadina. And so, we spent some time discussing it, and she joined us in January. So we moved her home. So she's with us. Number one is a teacher in Austin, Texas. She's a 4th grade teacher, and she's a volleyball coach and aspires to be a collegiate volleyball coach. So she's earning her stripes. Number 3 is just started her sophomore year in college. And number 4 is a 5th grader. I know for sure one will never get into our business. She just has zero desire. I'm pretty sure number 3, she also wants to be a teacher. I happen to come from a family of educators as well. So she wants, that's her life's passion. Jury's out with number 4. Who knows what that guy will end up becoming, but so far number 2.
Some time to figure it out.
Yeah, we got some time.
So let me ask you this. You said your daughter went to Creighton. That's if correct me if I'm wrong, but it's a private school, correct?
Correct.
And it's pretty hard to get into. From what I've been told. So
she was actually with daughter number 1 at University of Arizona. So they were playing together.
They're down. Woo!
Right now.
They're down.
Yeah.
Ashley and I had a little conversation about that. So they're both there. And it was a perfect fit for daughter number 1. Like, she loved Tucson. She loved the Pac-12. She loved everything about it. Number 2 didn't take to Arizona. She's really was in the School of Business and everything, and was really looking forward to being challenged. And she just, it was a combination of everything. She lasted a semester at Arizona, and she came to us, and she was on a full ride for volleyball, and she came to us and she said, you talk about change of plans, right? She's like, I'm entering the portal. And I said to her, you're doing what? She said, I'm leaving Arizona. And I said, okay, you understand what you're leaving. You're leaving the equivalent of X amount in scholarships, and you're not guaranteed that you're going to get that. So she actually left the compensation, right, and moved to Creighton, and she was a walk-on. She didn't receive any financial assistance for volleyball there. So she finished up her career at Creighton as a walk-on, and then she put 2 and 2 together and applied for the GA position. She was applying to other schools for B school. And Creighton, she just grew to love Creighton. It's Omaha's a fantastic city. I like to say the Aloha spirit is alive and well in Omaha, Nebraska. They're just really good people. And so one of the things that I teach my team as well as my family is surround yourself with good people. Bad company ruins good morals is scripture that I like to quote to a lot of people. And I think it's really important. And so she knew that it would be better for her to be at Creighton. And she was able to have that discernment that I didn't have as a mother. And so, yeah. So anyway, so she joined our team.
Thank you. So I wanted to ask you a question to delve back into the future of wealth management. As we all know, the landscape of wealth management is evolving rapidly. What are your opinions on the future of wealth management, especially in terms of emerging trends, technologies, and strategies that will shape the future of wealth management in the coming years?
Oh gosh, wealth management is an amoeba. The industry refers to it as wealth management. At Cadina and Company, and our clients understand that we take it to a different level. So the services that we provide, we call it worth management, right? So there's more than just your net worth that we're dealing with. It's lifestyle, it's intentions, it's succession, it's all of that. So that's been our offering from day one, is to look at the unique customized needs of clients. I will say that still continues 45 years later, still continues to be a value added. It's still something that others try to offer, but they just don't have the framework to offer. They if you're familiar with kind of like financial periodic chart, you have a period of time, then you have all the boxes, just like the scientific periodic chart. And a lot of people in our industry will preach to, because you see all these random performance and returns based on that, then you need diversification and you need to be in everything, right? And then most people look for the manager of a certain box. We first collect what our clients need, right? So rather than manage to a benchmark, an S&P 60 versus an AGG 40, we'll manage to the unique person. So that's a difference that in 1979 no one offered. That's one that's definitely, that was before financial planning was even called financial planning. So the trend is to offer more customized, unique, based on financial planning. And the other trend that I see in wealth management is that 90% of wealth managers outsource their investments. So they use, there's huge consolidation amongst managers, right? So the bigger just keep getting bigger. The BlackRock get bigger and bigger and bigger. You have all these roll-ups that are what we refer to as aggregators. They're just going out and they're buying strategies. They'll come in and they'll say, we receive calls quite frequently like, hey, we're interested in this strategy. And it's because most people are just focusing on now the financial planning part of it and the relationship management. So I think those are trends that have definitely come into place. You can't leave out ESG. I mean, ESG wasn't even discussed. There was social impact investing, there was all that, and it's really morphed itself into ESG. When you look at Cadinha Company, I mean, we're a minority-owned, women-owned, Native Hawaiian-owned business for 45 years. It's a box that very few can check. And there's a huge opportunity if I wanted to present the firm in that scope, right? And so you have a lot of institutional funds that have written into their directives to allocate X% to an ESG fund. I will say that this is where discernment, I think, is really important, because one of the jobs as a leader and an entrepreneur is to identify and find opportunities, right? You just got to be hunting and pecking all the time. But I think to just do that and then jump on every opportunity can really lead to difficult times and delusion, if you will. I think if you implement discernment, then you can identify what opportunities really speak to your skill set and your value added capabilities. And so, ESG is one that I know if we wanted to, we could hop all over, but it's that ESG, that's who we are. We've always been a minority. We've always been, it's not something that I have to go and have someone, in order to, there's entities that will basically endorse and say, hey, this is, and certify that you are ESG. I mean, to do that, I have to provide my birth certificate. And when I look at what it means to be labeled as an ESG manager versus the services we render, it's really not one that it's not an opportunity that I think, that we will go all in on. We're just going to be, and if someone identifies us as one that they desire, then we're happy to fill that box for them. But I'm not going to promote Cadinha as an ESG manager. But that is a huge opportunity. It's being written into so many directives, and I applaud it. I mean, I think it's great that more people are being compassionate towards people and strategies that are different than the mainstream. But I also feel that we are who we are, and we've always been, and we don't need to be categorized that way.
Thank you. I appreciate that. That's a great answer.
Yeah.
Now, what steps is your firm taking to attract and retain the next generation of investors?
That's a really good question, because our philosophy is based on preservation of capital. So that typically speaks more towards towards already accomplished professionals, to people who are maybe 10 years out from retirement. They're looking at kind of the next chapter in their life. They typically look for managers who are more conservative, if you will, in style. I go back to just our bread and butter of philosophy. So next generation, they're looking at hot dots. They all want to be 100% in NVIDIA and right. And I'm like, that's great for whatever portion of your money. But if let's just say you're at $100 and you lose half of it, now you're at 50, right? In order to get back to where you were, your break even at $100, I'll ask them, I say, what rate of return do you need on that? And they're like, 50%. We lost 50%. I'm like, no, you need 100% rate of return to get you back to 100. And with that, there's risks. It's there. Many of us focus only on the returns. What we focus on is the risk to get the return. So, we kind of, like I said, we're very non-conventional, non-traditional. We start with the risk. And if the risk makes sense to take, and it's prudent and it's a risk on, then hey, we have no problem being opportunistic and taking advantage of the risk. So to court the younger professionals, it's really through education. It's saying, this is suitable, the hot dot, the S&P, the benchmark, all of that, that's fine. And you have time to recover from your losses, but don't put it all there. It really makes sense to have kind of a nest egg, something, everybody has a pain point. So I like to identify what that pain point. If your original $100 goes to 50, are you good? If it goes to 30, are you good? Where is it that you're no longer good? And then I can speak to that, because that's your risk parameter, and that's what we'll customize our strategy to meet.
I like that.
I like that.
Yeah. And that kind of leads me into, segues right into the right next thing. So what investment and sectors have caught your attention lately, and how do you see them shaping the next wave of wealth management or wealth creation?
Super interesting question. So I will say, just 2020, when you look at 2023, the markets have been performing astronomically, in my opinion. I mean, and it's been on the backs of very narrow leadership. So you've had a few that have done really, really well. We keep naming NVIDIA, but there's a few others that have also done really, really well. But when you look at the broader markets, there's carnage in some areas. Right. There's like significant losses in certain sectors. And when you look at the disconnect, if you will, between valuations, there are some hidden jewels. Industrials come to mind. A lot of the big names have really run, and the valuations are also, I think, frothy. So we're really hunting and pecking. So, rather than looking at big conglomerates that kind of, again, this is the spaghetti on the wall, all boats rising. Those types of companies, large conglomerates, tend to do really well in risk on environments, right? All their boats rise of all their different entities. We're looking at very specific niche plays. So I'll give you an example of kind of our thoughts on it. One is, we know through legislation that there's this huge green wave, and there's incentives from various states, and then again federally on electric vehicles, right? So you can spend your time going through 10Qs and 10Ks on Tesla, Ford, Toyota, name all the car manufacturers, because electric vehicles, or you can look for the common thing that all of them need. And one of the basic needs of all of them is copper, right? So that you need
very true
in order to so if you know that there's going to be a change in demand, there's going to be more people who are going to be wanting electric vehicles, and they're going to be subsidized by some state governments, they're going to be incentivized by the federal government to purchase those, then rather than incur additional risk of picking the wrong horse, just buy something that they all need. And so we bought a long time ago, I'm talking like 4 years ago, we purchased we purchased one of the largest copper miners. Because it just made sense. You have the electric vehicles themselves, but then you also have the stations, right? They got to build these out. You have the electric conduits. So real specific niche type of things. I think that's the environment in which we're investing. The AI is relatively new. I mean, it's been long in the tooth. I mean, we've had artificial intelligence research going on for years and years and years and years, but it's a relatively new trade, if you will. And so, will leadership still be with NVIDIA versus, is it through the chip manufacturers? I think there's niches within AI to play as well. So that's kind of where we're hot. And then looking for valuations, just, rotating. We're beginning to see, again, sector rotation. And the year started out really strong with value, and growth was beaten up in 2022, and then growth came roaring back on the backs of 7 names. So just watching sector rotation.
Well, thank you. Go for it, Ashley.
Oh, I was just going to say the innovations are really captivating right now, and AI is making waves across industries. It's something to be on the lookout for.
Yeah, I agree.
Opportunities, but also disruptors. We still have to, one of the things that we're concerned from a macro perspective is the consumer. I spoke a little bit about it earlier in our conversation, and that we're beginning to see cracks in the consumer. We are, no argument from anyone, a consumer-led economy. And so if the consumer doesn't have the discretionary income to spend and continue to spend, we're going to have economic slowdown. It's been a significant portion of spending has been placed on the back of the government, right? So we like to refer to it more as like industrial production. But when you look at economies that are dependent on industrial IP, China comes to mind, right? So IP types of economic policies are good on a short-term basis, but are not long-standing. You need capital to move freely. You need money to reward risk-taking, and we're just in a time where things are kind of upside down. You have an inverted yield curve. I kind of don't really even need to say more than that's the environment in which we speak. So I just want to caution. I don't want to give the interpretation that we're super bullish about the markets. I think when we are bullish on the markets, the lesson that I'd like to be able to offer is that that's an opportunity to just like in Hawaii, you throw the net, you throw a big net, you're going to catch a lot of fish. But if there are not a lot of fish and you got to hunt and peck, then you're not going to use a big net, right? You're going to use a spear, and you're going to go and be very direct. We're in a period of time where I don't think casting a big net for investments is warranted at this time. I just don't see it in the tea leaves that I'm reading.
You think the spear approach right now is the better approach?
I think it's the most prudent approach. I just the broader market, we need some economic growth policies to come into place that warrant the big net approach, and we're just not seeing it right now.
Gotcha. And you know what? So I had one last question here.
Sure.
So, looking into the long term, how do you see economic factors and global events influencing financial markets and investment strategies? I know we've somewhat highlighted on that, but if you could give me an answer on that, I'd really appreciate it, because I really like what you've been saying on everything. I really like what you said about copper. I'm going to research that as soon as we get off the cast here.
So, materials get dicey if you have economic slowdown, right? So
I agree.
Pick your entry point when you're dealing with materials. That's why I kind of preface it by saying, we started a long time ago.
You're like, hey, you're late to the game. We started 4 years ago.
But the thesis still stands, right? I mean, as long as we can't control, regulatory action. That's one thing I really left out that I think anyone in wealth management has to be on the lookout for is increased regulation. The amount of time that I spend now on compliance is dramatically different than even 5 years ago. I mean, we have new forms, all new stuff. The new marketing rule from the SEC that we all needed to implement just recently. It's just increased regulation, and we're not, it doesn't. how do I say this without having them not for me now. It doesn't, in my opinion, it doesn't. I understand the intent, and this is where I think my experience in working with in civil service, in working with the federal government, I understand that a lot of regulations are made with good intentions, but the outcome and the consequences of them aren't where the intentions were. So I can understand from a regulatory aspect that we want to protect the average investor. We want to make sure that investing is safe in the United States. What you see is what you get. Transparency, fees, all of those things. We are strong advocates for that. I mean, if you want my pitch book, I'm going to be talking about fiduciary responsibility, about fees, about all these different things. So we're supportive of that portion of it. But the way that regulations are beginning to come out is it's becoming extremely punitive for us to operate and to demonstrate that we're doing those things. So it's kind of like guilty without even going to trial, right? You have to prove, you have to document, and the cost on our business to comply with the new regulations is extremely high. Totally different than it was in 1979. Definitely even different than it has been from 2007. It's unfortunate that a few rotten eggs kind of spoil the whole dozen, and that the rest of us who have been operating and take our fiduciary duties at heart and do an extraordinary job are left and saddled with the additional burden of demonstrating compliance. So that's an area that's, I get it, I understand it, but it's something that I think someone new to the industry just isn't prepared for. It's a lot.
Yeah.
So sorry, getting back to your question, Mike, what do we see geopolitically? We're watching things, tensions. I don't need to tell anyone in the room about Russia and Ukraine, but you also have, China heating up. And so, we're in a period of time where you can't ignore the geopolitical tensions. Interestingly, I'd like to share, last week there was a pretty significant meeting. You may have heard of it, the BRICS economies coming together. So Brazil, Russia, India, China, they've come together and they're proposing kind of a rival group to the G7. And in this is a dynamic that deals directly with currency, looking at a way to have a centralized currency. And I don't know how other professionals read it, but it's one that we're watching really, really closely.
Wow.
Because when you look at the dynamics of central banks around the world and just trade in general, right? Because we're a consumer-led economy, we're consuming goods. The majority of the goods are produced and manufactured outside of the United States. So right. by buying my Apple phone or whatever it is that you're purchasing, a lot of, if the end product is manufactured in the United States, a lot of the components and all of the insides are manufactured elsewhere, right? And so that just by virtue of that transaction, our dollars, our greenbacks are going to other countries. And then the central banks have their policies in other countries of what portion of that dollar should be, what portion of their reserves should be held in dollars. So this BRICS meeting is pretty significant in kind of the future of our dollar. And so I don't think there's anything to be worried about, but you'd have to have blinders on to see kind of the movements in alternatives to the dollar. You have cryptocurrency, right? That is one. And then you have all the other currencies that are out there. And now the potential for some of the big countries out there coming together and saying, hey, we're going to consider this. I think that's a pretty significant shot across the bow at the United States, and it's something that we're watching pretty closely because it affects the purchasing power of our currency, which affects everything else, right? It's kind of like interest rates. Interest rates affect everything. So does the value of our currency. So that's a big kind of macro trend that we're watching pretty closely.
Yeah.
Wow.
Thank you. That's a great answer. I appreciate that.
Yeah. And thank you so much, Kalei, for being here with us today. Your insights are truly, your wealth of knowledge. And I really feel like I learned so much, and I know our listeners did as well. Thank you so much for sharing your wisdom with us. It's quite powerful, and your wealth of knowledge. We really appreciate having you here with us today. It was a pleasure.
Well, Ashley and Mike, thank you guys so much for having us. Having me on board. I applaud everything that the two of you are doing, and everyone just getting information out. I think is really, really important. And so, thank you for the role that you play in getting the information out. And I consider myself extremely blessed to be a part of this, and look forward to for days to come with you two and learning more. I'll keep listening. I hope others will as well. And please don't hesitate to call in the future.
Oh, well, thank you.
Thank you.
And to our listeners, thank you for tuning in to another enlightening episode of the What Matters podcast. Stay curious, stay informed, and join us next time as we continue to explore the exciting world of wealth management and financial innovation. Thanks, everyone.